Okay, so welcome guys today to our video where today I'll be walking through you guys to know how to do the efficient frontier on Excel, and today we'll be doing for a 6 asset portfolio. However, before we going into the actual Excel itself, I want to have some notes. Is that you can do this for any type of in any number asset of asset in your portfolio. You can do it for 3, 4, 5, 6, 7, 8, 9, etc. It's pretty much gotta be the same steps like I'm gonna do here. Also, I'll be providing the this file under the description for you guys to to have it, to collect it, or you guys can do it along with me. Yeah. And I have okay, so we'll go into the video and I'll be explaining as we go. So I've actually done some preparation beforehand. Here I'll have the steps that we have to do over here. So step 1, firstly we have to collect the data. We have to collect the data for the 6 assets that you guys want to do for the portfolio here. And so I've collected beforehand the 6 asset here. What I've done is I'm just gonna take note right here. So I've taken the closing price of 6 assets of 6 of these stocks right here, and I've taken the weekly return, right? You can do you can get the daily return, the monthly or yearly return, whatever. It's up to you, right? It's all fine. You can do this with any kind of returns, and there are many ways for you to collect this data, but one website that I recommend is investing.com, because it provides data for you for free. Okay, so after I've collected 10 years of weekly closing price data of these 4 stocks right here. The first step that we have to do is data collection, which we have done. Now we'll be calculating the weekly return. Well, actually we can calculate the weekly return. You can calculate the daily or the yearly, whatever. Here I have the weekly closing price, so we will firstly do the weekly return here. The formula is very simple. We will take the closing price of the following day divided by the closing price of the previous day, and we minus by 1, which will get a percentage right here. And I'm just gonna drag it to the side and under, yes, all the way down to our here. And I'm gonna leave this last row here because it does not have anything to divide in the row 510 here. Okay, now we'll come back. Okay, so that's the second part done. Second step is done. Very simple. Next, we'll be calculating the mean return and the standard deviation, which is the risk of these individual stocks. So for the mean return, if I want to collect the weekly mean return, I'm just gonna do the average here, and I'm gonna do for the whole column here. Okay, so that's the weekly mean return, and I can do that for all. But I will probably today I'm gonna do yearly for you guys, and it's very simple. You just have to tweak the formula a little bit. Is that we're gonna change it into a yearly return, so it's 1 plus the average return, and because we are weekly, we're gonna do it to the power of 52, because there are 52 weeks. If these of yours are daily return, you're gonna do it to the power of 252, because there are 252 trading days in every year, right? If it's a monthly return, then you're gonna do it by 12. But here I'm gonna do it by 52. And then I'm gonna -1. Right. Okay, that seems about right. And then to the standard deviation. The standard deviation, Excel have provided us with a very simple function here. Is we can calculate it directly. Here we're gonna do the standard deviation plus s. S means sample because it's only the sample. It's not the whole population. If you collected the data from the beginning to the end, then it's the population. But here I've collected only 10 years. Okay, we've got our standard deviation here, and just gonna pull it. So yeah, we got the standard deviation for each of the stock. Next step, we're gonna be doing the covariance matrix right here. The covariance matrix, what we'll be doing is we have a very powerful function. Not function, it's a tool in Excel, right? Is here we have the data analysis. If you guys don't have the data analysis and the solver available, you're gonna have to go into tools in Excel, and you're gonna go here, Excel add-in, and you're gonna add both of this in. Okay. I'm using a MacBook, so it might be a little different for Windows users. But here we're gonna go to the data analysis. I've already chosen here. I'm gonna choose the covariance, right? There are a lot of tools we can use, but here, yeah, we're gonna choose the covariance. The input range, I have here. So input range is gonna be the weekly return here, right? I have already chosen it, the data return here. And the first row, if you guys have realized, is we have the ticker name to the stock symbol, and so that's why we're gonna tick the labels in the first row. If you guys only choose a number, you guys won't tick this, but yeah, we'll do this so that it will draw the table for us. Here we have the output range. I'm just gonna put where the name covariance. Oh, oops, to do that. Okay, I'm gonna do this again. Okay, the output range is gonna be the covariance matrix here, the letter here, right? And then we're just gonna press OK. It wants to override the data because I've written some here, so it's fine. Here it has provided us with the covariance matrix table. I'm just gonna write covariance matrix right here if I can write it down. Okay, covariance matrix. And this is not the full box, right? Because we're gonna have to fill it in. We're gonna use the transpose function here. It's gonna fill this row here with these 5 to make the full box. Excuse me. Transpose here again. Transpose these 2 and transpose this last one. Okay, now we have a complete table. Alright, this is it's very simple because Excel have provided us with the tool. On to the next step, we'll be starting to calculate the portfolio, right? Not yet to the min variance and max sharp portfolio, but we'll get there. Firstly, we're gonna just calculate an equally weighted portfolio. So the total weight here is gonna be the sum of the weight, because there are six assets. We're gonna do 1 divided by 6. Well, one it should be like this. 100% divided by 6. I forgot the here. Okay. All right. Drag it. The total weight is gonna be 100%. Next, we're gonna be doing the return for the portfolio. So we're gonna use sum product, right? I've also have some notes on the side here for you guys to follow me more easily. Okay, sum product, which we're gonna have the sum product of the mean return and sum product of the weight. we'll have come up with a return of 17.82%. Next is the standard deviation. This is gonna be a little bit more complex, so here you guys can follow me. What we're gonna use, right, is we're gonna use the mult, which is the matrix multiplication function. First, we're gonna add a square root function because it's a standard deviation. What we are trying to calculate here is the variance, so we'll add the square root before. Then we'll do the matrix multiplication mult function. Mult again. So what we'll do here is we'll multiply the weight here with the covariance matrix. We're just gonna do all this, right? And then we do a transpose of the weight. And we close it. And I think we should be finished. There's a transpose and mult. Oh, we forgot the comma here. It's fine, it's fine. Right, we have standard deviation, but this is just the weekly, so we'll have to multiply it by 52 weeks. And we get the yearly standard deviation of these stocks of the portfolio equally weighted. And lastly, we'll be calculating the Sharpe ratio, which is the excess, the additional return that you get for every extra unit of risk. So the formula is really simple. We're gonna take the return here, the return. We're gonna minus it by the risk-free rate, and then we're gonna divide it by the standard deviation. I also haven't told you guys about the risk-free rate of 2.2% here. Normally, we will take the the 10-year government bond rate, yeah, and that's what I've taken. Is 2.2% currently. Okay, so this is the equally weighted portfolio. We use the Sharpe ratio, the return, and standard deviation. Now, okay, here we'll have the minimum variance portfolio, which we will use solver for. Okay, so firstly, the return is the same. It's just gonna be the same. So first I'm gonna just do the total weight here, the sum of these. We'll be using solver for this, so we can just do random numbers here right now. And then return is gonna be the sum product, just like we just did with weight here, and the mean return up here. The standard deviation is gonna be the matrix multiplication, and to save some time, I'm just gonna copy paste this formula down. And here. Okay. No, I have to copy like this. And yes, okay. So it moved the weight to down here, but because I add some dollar sign to here, it's gonna keep at the matrix, the covariance matrix. Okay, and the Sharpe ratio, which is gonna be the same down here too. Okay, so now we'll be trying to find the portfolio with the minimum variance. So we'll use solver. If I can open it. Okay, so first we have to set the objective, which is the variance, which is here standard deviation. We putting it at minimum. We're going to be changing the variable cells of the weight of the assets. We're going to add some constraint, which is the total weight needs to equal to 1, and that's it. You can also tweak a few with the solver, like you can add like all our assets here to like well you can add, like if you want to at least buy like 1% of each, you should add like this whole array here should be oops, I didn't mean to do that, I'm sorry. It should be like bigger than like 1%, right? I'm not gonna do that here. You guys can do it, or if you allow for shorting stocks, we're gonna not take the make unconstrained variables non-negative, right? But I'm not gonna do that here. Yeah, we're not gonna allow short. It's like your preference. So yeah, and then we choose GRG non-linear. Check the stuff again. Okay, I will hit solve. Ooh, okay, it's lagging me a little bit. Okay, we'll come back. It was lagging a little. Okay, so here it has found a solution for us. We press OK. So this is going to be the portfolio that has the minimum variance. So I guess we can see the allocation here. Next, we're going to be looking at the max Sharpe ratio portfolio, which is going to be helpful for us to draw the capital allocation line. If you guys can see over on this side. So the return is going to be the same sum product of the weight. Okay, I actually need to do the weight first. Okay, this shouldn't be here. I made a mistake. I'm sorry, guys. Okay, here the total weight should be the sum of these. Done. Here we're gonna do the 10% thing again. 10%. We're gonna percent back here. Okay. Return is gonna be the sum product here. Okay. Weight. And the return up here, and we're gonna turn it into a percentage as well. Standard deviation, same here. Check again. Yes, it's correct. Sharpe ratio here again. Okay, so the concept is pretty much the same. What we're gonna do again is we're gonna run solver. They're gonna set the objective here of the Sharpe ratio, put it to max, changing the variable cells of this weights down here. Subject to constraint is we're gonna change the cell reference, the total weight to 1, and we are set to go. We're gonna solve. It may lag a little bit again, so bear with me. I'm sorry, guys. Okay, thank you. It has given us the Sharpe ratio of the maximum Sharpe ratio portfolio of 170.4%. Okay, continuing here, this is where we're gonna be doing the efficient frontier, which is here the next step. Well, we will do simulation, then the efficient portfolio, efficient frontier. Okay, I got a little too excited there. So, the thing here, we're gonna do a little different with the weight. First, we're gonna assign a random array here. So it's gonna be random here. Just random numbers, which is gonna run again every time we press something. Okay. Here we're gonna have a little bit of the sum of these, and we're gonna have the weight, which is gonna be this divided by this. Do all this, which would give okay. Sorry, this should be in dollar sign to lock it in. And what we're gonna do is we're gonna pull here, turn this into percentage so it's easier to look at. So it pretty much gives us a random amount of weight to each of the asset here, which I see is 100%. It's correct. The return is going to be the sum product again of the weights and the mean return. The standard deviation, the same. Check again. Yes, we are correct. Sharpe ratio, while the Sharpe ratio here isn't that important anymore, but okay, it's here. Right. So what we're gonna do here is we have to run simulation. Here I've prepared simulation for 5,000 simulations. What we're gonna do is we're gonna run 5,000 simulation to see 5,000 different portfolios, and then we're gonna plot it onto a scatter plot. So there's a trick for this. So firstly here, the portfolio standard deviation, we're gonna equal to standard deviation here, as well as the return. Okay, should change this to percentage, and yes, okay, just for it to be easier to look. Okay, so what we're gonna do here, we're gonna do a trick. with another thing is the data table. Right, we're gonna do the data table. So first I'm just gonna pull all this down here. Okay, I'm gonna do the data table, the column input cell. You just click any random cell that is not occupied, press OK, and it's gonna run 5,000 simulations for you. It's lagging a little bit. My computer sometimes get a little slow with Excel. Mac isn't the best, so it sometimes, you know, is a little slow like this. Okay, we have got it. Otherwise it's full, but you know, if you have a slow computer, go down to like 1,000, 2,000 simulation is fine too. And let's format this so that we can look at the number a little bit like better. Okay, I didn't mean to do that. Okay, that's fine. So what we're gonna do here is we're gonna insert a scatter plot. I have a scatter plot here. We're gonna select data. We're gonna add here a new series. The x values is always gonna be the standard deviation. So down we go. And the y value is gonna be the return. Yes, it should be here. Should be a 29, I think. So that's 30 and 30. Oh no, it's 30. Okay. Okay. Okay, we got it. Here, this is our efficient, well, the plot here. So what we're gonna do is we're gonna, you know, change the data a little bit so that it looks nicer and we can see what's going on. So format the data series. I'm gonna change the marker here, which is these dots, to a little smaller. Here, some dots. Okay. And we are gonna try to change the format these as well. It's not that important, but you can change it so that it looks a little nicer for the viewer, which is you guys. Okay, 0.1. Yes, okay, that looks better. I'm gonna change here as well. Select data. I'm gonna not select data. I have to format this axis here, which I'm gonna press. I think minimum is gonna be like 0.15. Let's see. I can go 0.17. Yeah. Where's it? 18. Okay, this looks a little bit better. As you can see, these are the simulations that we have plotted onto here. Make it a little bigger for you guys too. Okay, so that's pretty much we have done. But we're gonna be drawing the efficient frontier. So the way that I like to draw the efficient frontier here is we're gonna have to use solver too. Okay, so what we actually want to do here is to draw a parabol, which is our efficient frontier, onto this graph using solver. So first, we're gonna have to find the maximum and the minimum return that this portfolio could bring. We're gonna put it right here in the equally weighted here, which is no longer gonna be equally weighted. We're gonna use solver. What we want to do here, of course, set objective is the return to be max. Return, yes, to be max. Changing the variable cells of the weight, and we will have the constraint is the total weight to be equals to 1. We're gonna be okay, and we're gonna solve. And we have found our solutions to be the maximum return of 29.38%, we're gonna copy and then we're gonna paste the value down here. Okay, now we're gonna do the same thing again. We're gonna do the minimum. Yeah, just change this to minimum. We press solve, and solver have found a solution which is a 6.29% return, which is a 6.29% return. So we're gonna also get this, and we draw it here from the values. Okay, so what we want to do here, right? This is pretty much 6 to 29.38%. So I'm gonna move this risk-free down a little bit here. Okay, so what we want to do is okay, so what we want to do here is we're gonna draw the efficient frontier. We're gonna have, okay, we're gonna do some quick math here. We're gonna have this minus 6%, right? And we're gonna divide it by 9. Okay, so we have 2.56%. What this does is we're gonna have this equals this minus this cell. Okay, so here I'll explain it. It's pretty much we're giving the points for the parabol. You can, create more portfolios so that the there will be more points and it will be around the curve. But I'll do 10 for now, and I think 10 is probably fine. And what we do here is, we have the return here. We have the steps of returns. Now we'll have to find the standard deviation. So firstly, the standard deviation, here we already have for 6.29%, is this number, 0.3, paste special values. Okay, so now we're gonna do here is we're gonna set the objective. We're gonna want the standard deviation here to be the minimum by changing the weight, of course, and then subject to constraint is the weight equals to 1, and this return must equals to this return. Done. And we're gonna solve to find the standard deviation. Yes, which we have found here. Place the value here as well. Values. We're gonna paste the values. Sometimes it doesn't show up and I don't really understand why. Okay, and then we're gonna do the same again for the next one here. Go to solver again. Here, we'll change this from R54 to R53. We solve to find our standard deviation. Yes, we found another solution, which is 0.24 special values, and we're gonna repeat the rest too. Now I'm gonna do it by myself here. You guys can pause the video or whatever while you guys do this as well. Okay, so what I just did here is I actually spent more time, like 30 minutes, doing all of this with solver to draw a better efficient frontier with many more points. And when I tried to draw it, I can see that the efficient frontier is not is not surrounding the the thing effectively. So I figured I made a mistake, which is right here. I'll show you guys. Select data. When I selected the data for the scatter, the standard deviation here, it should not include row 29. It should start from row 30, just like the return, right? That's where I made a mistake. Here I would change it. So that it starts from this row, and as you can see, our efficient frontier should be good now. And okay, let me delete the efficient frontier so I can show you guys how I can draw and plot it again. Is you go to select data, you add another series, you start with x, which is the standard deviation, and y is the return. Okay, and you just press OK, and as you can see, it shows here. I don't know why this line is not drawing. Yeah, okay, yeah, okay. So this will be our efficient frontier, right? And of course, it does not look like the most beautiful, because usually when you have more assets in your portfolio, it does look a little bit like not so round. That's what happens. And so lastly, we'll go into our CAL, our capital allocation line, and it's pretty simple here. We pretty much know the optimal portfolio, which is here, the one with the market cap ratio. And what we're gonna do to draw this is, of course, the return is gonna be the weight of the optimal portfolio times its return. Here, I'm gonna lock it in, plus the 1 minus the weight here, which is gonna be the weight of the risk-free portfolio right here. I'm gonna lock it in and press enter. Then auto adds, as you can see. Of course, with 0% optimal portfolio, it's fully risk-free and it's 2.2%. Also, you can do like shorting. You can also do short, right? Like here I stop at 100%. You can do 101%, 102%, or like minus 1%, minus 2%. You can do that, but in Vietnam you can't short, so I chose to do from 0 to 100% only. And standard deviation, of course, is just this times standard deviation, because the risk-free portfolio does not have risk. It's risk-free, right? Okay, so this is going to be our numbers for the capital allocation line. Here I'll just press select data again, add another series with x being the standard deviation, and y values will be the return. Press enter, and I press OK, and that's our capital allocation line. Okay, should not have the return here. Okay, let me just change it again. That usually happens when you okay, let me, oh no, it's this one. Okay, 29 and 30. I should start from 30. Okay, now that's our capital allocation line. And yeah, so as you can see, we have our efficient frontier, our capital allocation line right here. And of course, the optimal portfolio is up here, and right here I can try to highlight this this dot. It does not really show, so it's a little bit difficult, but you guys know there is the most the optimal portfolio. And so yeah, that's pretty much it. You guys can spend more time, play around with it, do more simulations, do the with shorting. You can add more constraints, for example, shorting here as well with the weights, or maybe draw a even rounder efficient frontier if you guys have time, and mess with the numbers, mess with your stocks that you want, or maybe add more stocks, or subtract stocks. It's really a lot of fun that you can play around in this Excel model, and it's really convenient, and I think it's relatively simple for everyone. And yeah, so that's pretty much it. Thank you guys so much for watching this video. I would love to hear your feedbacks, your comments, how you have experience with this. I've of course linked the file in the description for you guys to use as well. And yeah, any suggestion, anything, or like what is your experience with this? And yeah, I thank you guys so much for watching, and I will see you guys next time in another video maybe. Thank you guys so much.